Happy St. Patrick's Day, everybody. What a great day to wear green. March Madness has begun. My Spartans play today. Should be a great day for basketball. Well, the big news this week was surrounding the banks, Silicon Valley Bank, First Republic Bank, a lot of the bailout news that came out. And actually today was really weird. You had 11 large banks depositing $30 billion in First Republic to help rescue them, basically. And we're talking about 120 days they have to keep their money there. Well, what happens after the 120 days is over? We don't know, but they're doing this to create more stability in the market, especially around banking. So, the first bailout with Silicon Valley Bank, $54 billion, and then they filed for bankruptcy. So a lot of the news this week revolved around banking and what's going to happen. But basically, they're just trying to create stability right now. And let's think about this for 1 second. What happened here with this bailout of the 11 banks bailing out basically their competitor. It'd be like Janet Yellen going to Target and Walmart to bail out Costco. And so let's talk about why did the banks fail? Well, really, you have three big reasons. One being the Fed's being so aggressive with raising rates. And then at Silicon Valley Bank, you had a period of time from April until now where they didn't have a chief risk officer. So you had someone falling asleep at the wheel as rates are going up and as, profits are going down because they're losing money. You have an inversion of the yield curve, basically, where the 2-year bond's paying more than the 10. And with these aggressive hiking of rates, you have the depositors' money. Basically, 90% of the money is invested, and the banks are only holding 10% to the side. That 90% is losing money month after month after month with this chief risk officer that doesn't exist, not there to stop it. So a lot of that is what happened, and that's why we're in this situation we are today. With all the instability in the market right now, it could be a good thing for rates. We'll see. As of right now, we're looking at 6.5 is the median rate right now, the average rate for a 30-year fixed, 6.5. So all those people that waited, now's a great time. We're just in time for spring market, 6.5% rates coming off a 7.25% high of a couple of weeks ago. New construction home starts, the first time in 6 months in February, up 9.8%. New construction applications up 13.8%. So good news on that front. Next week, we're going to get more housing data. We're going to get existing home sales as well. In the big meeting, the Fed meeting on the 22nd. So most people are predicting that they are going to raise maybe 25 basis points, but then there's others that are saying it could be 0. But let's think about that. If they do 0, that could crash the market because it's been expected that they were going to do 50 basis points. So now the markets have kind of priced in at least 25. So we'll have to wait and see what happens. We are expecting a lot of volatility next week in the bond market as far as mortgage rates. There could be a lot more whipsawing next week. And on a side note, FHFA was putting out a loan level price adjustment for debt to income ratio. Those over 40% were going to have a higher interest rate. They've paused that now until August. So obviously not a good time to do that with rates being higher. Obviously somebody thought about that. Anyways, I'm Jeff Suloff. Hope you have a great weekend. That's your Mortgage Minute.